Welcome to Tech Money Madness, your daily U.S. stock market podcast. It's Thursday, August 27th, 2026. Today, we're looking at a market that is just, well, it's utterly defying gravity right now.
Yeah, it really is.
I mean, in a single day, one tech giant just added more value than the entire GDP of South Africa. We're watching AI and, cybersecurity stocks aggressively drive U.S. equities upward.
Right.
And it's putting this massive, incredibly lucrative bow on the Magnificent Seven earnings cycle. But underneath this absolute AI euphoria, there is a quiet crisis brewing in housing and inflation.
Exactly. And the Fed might be completely underestimating it. It's a fascinating collision of two totally different realities, really. On the micro level, corporate tech data is printing numbers we've just never seen before in the history of public markets.
Yeah, it's unprecedented.
But on the macro level, the market is positioned just hours away from the Jackson Hole Economic Policy Symposium tomorrow. Typically, the days before Jackson Hole are characterized by extreme caution. Capital goes to the sidelines.
Right, people wait to hear what the Fed is going to do.
Exactly.
But not today. It's like the market is staring right at the Federal Reserve, seeing the macro risks, and saying, well, we don't care. The fear of missing out on this tech rally is entirely overriding the usual pre-Jackson Hole anxiety.
It's wild to watch.
So let's get right into the engine of this euphoria. We have to start with NVDA. They just delivered their second quarter results. And calling it a blowout feels like a disservice to the English language.
Yeah, the scale is almost hard to comprehend. We're looking at $96.2 billion in total revenue. That is a 106% increase year over year.
Wow.
But if you want to understand the actual mechanics of this AI boom, you have to isolate their data center revenue.
Okay, let's look at that.
That hit $89 billion, up 117%. Earnings per share were up 120%. They aren't just beating Wall Street estimates. I mean, they are completely rewriting the textbook on how much cash a hardware company can physically generate in a 90-day window.
Right, and it's not just the backward-looking numbers either. The forward guidance is what sent the stock into the stratosphere.
Yeah.
They're forecasting roughly 70% revenue growth for the upcoming quarter.
Right.
And then CEO Jensen Huang drops this incredibly specific quote on the earnings call. He said, "Our demand is much greater than 70%.
Which is the most important sentence of the entire earnings report, honestly. Huang is telling the market that NVIDIA is not demand constrained. They are purely supply constrained.
So they just can't make them fast enough.
Exactly. They're guiding for 70% growth only because that is the physical limit of how many chips they can manufacture, test, and ship. If Taiwan Semiconductor could fabricate more silicon for them, that growth number would be 90 or 100%.
Oh, wow.
Yeah, it confirms that the massive AI infrastructure build-out is not slowing down.
Wait, I have to stop you there and inject some reality into this because I look at these numbers and my dot-com bubble alarms start ringing. Because of this report, NVIDIA gained over $400 billion in market value in a single day.
Yeah, it's a massive number.
$400 billion. That is the equivalent of adding the entire market cap of a company like Home Depot or Chevron to NVIDIA's valuation between breakfast and lunch. Tell me why I shouldn't look at a single-day jump like that and immediately assume we're pricing in absolute, flawless perfection forever.
Well, your instinct to call it a bubble is completely rational when you hear a number like 400 billion. But look at the underlying math. The earnings per share growth was 120%.
Okay.
The actual realized cash flow is expanding at a rate that matches, and by some metrics outpaces, the valuation expansion. In a classic bubble, you're buying a story. You're buying a concept of future earnings.
Right, buying the hype.
Exactly. The market right now isn't buying a story with NVIDIA. It is buying $89 billion in cold, hard, quarterly data center revenue. So yes, the market is pricing in perfect execution, but NVIDIA is currently executing perfectly.
Okay, let's play with that idea. If NVIDIA isn't selling a story, they're selling the basic concrete and steel for the digital factories of the 21st century. But eventually, someone has to rent out those factories and make a profit.
Right.
Which brings us to the software layer, specifically Salesforce.
The hardware numbers ultimately mean nothing if the enterprise software companies buying all this computing power can't monetize it. And Salesforce just proved that the monetization phase has officially arrived.
They surged 22% today.
Yeah.
For a mature mega-cap software company, a 22% jump in a single trading session is historic. It was their second best day in company history.
Yeah, it was driven by a powerful combination of announcements. They delivered a strong quarterly earnings beat, but more importantly, they announced a massive expansion of their AI partnership with Anthropic.
Ah.
But the core catalyst, though, was CEO Mark Benioff explicitly shooting down the Suspocalypse narrative.
Let's break down the Syspocalypse for a second,
You
because this
wanna?
has been the dark cloud hanging over software stocks all year. The fear was that artificial intelligence would cannibalize the traditional software as a service, or SaaS, business model. The logic was, if an AI agent can do the work of 5 junior sales reps, an enterprise company is going to cancel 5 Salesforce software licenses. Basically, AI would automate away the human seats that these software companies charge for.
That was the overriding fear. Wall Street assumed enterprise clients would just stop buying SaaS licenses and build their own internal AI tools instead. But Benioff came out today and argued the exact opposite with hard data.
Oh, really?
Yeah, he demonstrated that enterprise software demand is actually incredibly robust, and AI is acting as an accelerant, not a replacement.
How does that actually work in practice, though? Like, how does adding an Anthropic AI model make a Salesforce subscription more valuable rather than redundant?
It comes down to workflow integration and switching costs. When you integrate a sophisticated AI model directly into an enterprise platform like Salesforce, that AI begins learning the specific quirks of your business.
Oh, I see.
It learns how your sales team communicates, it learns your brand voice, it understands your specific customer history. Once an AI agent is deeply embedded in your daily workflow, writing your emails and predicting your sales pipelines, changing software providers becomes virtually impossible.
The lock-in effect is absolute.
Exactly. It makes the software incredibly sticky.
But does this mean the broader software sector is safe? I mean, Benioff is notoriously confident, and obviously Salesforce is a juggernaut. But are we seeing a rising tide lifting all software boats, or is this a case of the rich getting richer?
It's really the latter.
Are the AI-integrated giants thriving while quietly bleeding the legacy traditional SaaS companies dry?
We're definitely seeing a consolidation of enterprise budgets. Chief information officers are looking at their finite IT spend and saying, well, we're cutting the legacy apps that just host data in the cloud, and we're pushing all our chips toward platforms that offer embedded functional AI. So Salesforce is on the winning side of that consolidation. The Suspocalypse might be canceled for the top-tier platforms that have the capital to integrate models like Anthropic, but if you're a smaller legacy software vendor without an AI strategy, your budget is absolutely getting cannibalized.
So the money isn't disappearing, it's just moving to the highest functioning platforms. But this integration of AI into every single software seat creates a terrifying vulnerability, doesn't it?
Oh, absolutely.
Because if you give a highly intelligent AI agent access to all your proprietary corporate data, your customer records, your internal communications, and a hacker compromises that AI, they have the keys to the entire kingdom.
Which is exactly why the adoption of enterprise AI is acting as a massive force multiplier for the cybersecurity sector. The more intelligent and connected your enterprise stack becomes, the more sophisticated the attacks against it become.
And that perfectly explains the cybersecurity rally today. CrowdStrike had its best day ever, up 15%. Okta saw a massive surge, up nearly 29%.
Yeah, this is the defensive reality of the AI boom. Hackers are now using artificial intelligence to automate their attacks. They can use AI to scan millions of lines of corporate code for vulnerabilities in seconds.
Wow.
Or automatically generate thousands of perfectly written phishing emails tailored to individual employees based on their LinkedIn profiles. A traditional legacy firewall cannot catch that because there is no malicious code attached.
Right.
So to fight offensive AI, enterprises are realizing they must adopt defensive AI.
So it's a literal arms race.
Right.
But break down those specific companies. Okta is up 29%, CrowdStrike is up 15%. What exactly are they doing that a traditional firewall doesn't do?
It's a complete architectural shift in how we secure networks. Think of legacy security like building a massive castle wall. Once you were inside the corporate office, behind the wall, you were trusted.
Okay.
But today, an employee might be accessing sensitive AI tools from an iPad in a coffee shop in London. The castle wall just doesn't exist anymore.
So the security has to travel with the device.
Exactly. That's called endpoint protection, which is what CrowdStrike specializes in. They secure the actual laptop or phone, the endpoint, acting more like a biological immune system that constantly monitors the device for abnormal behavior, regardless of where it is in the world.
Oh, that makes sense.
And Okta specializes in identity verification. Since there's no corporate perimeter, you have to constantly prove you are who you say you are before you can access the AI tools. When you deploy AI agents that have access to everything, identity and endpoint protection become completely non-negotiable.
But is this a one-time panic buy?
Yeah.
Like the early days of the pandemic where everyone just bought a VPN overnight? Or is this a structural, permanent expansion of what it costs to safely run a business?
It is a permanent baseline increase in IT budgets. You cannot roll back AI adoption, which means you simply cannot roll back the security required to protect it.
Okay, so we have the hardware foundation with NVIDIA. We have the software application with Salesforce. We have the defense with CrowdStrike and Okta. But none of this works without the underlying ecosystems, which loops us into the rest of the Magnificent Seven, specifically Apple and Microsoft, who just closed out their earnings cycles.
And both of them delivered metrics that validate everything we've just unpacked. Let's start with the enterprise side. Microsoft reported 18% overall sales growth and 23% earnings growth.
Right.
But the metric Wall Street obsesses over is Azure, their cloud computing division.
Right, because Azure is essentially where Microsoft rents out access to NVIDIA chips.
That's the perfect way to look at it. Microsoft is spending billions in CapEx, capital expenditures. They're making massive upfront investments to buy NVIDIA hardware, put it in their data centers, and then rent that computing power to businesses via Azure. Azure Intelligent Cloud revenue just hit $39.3 billion. That is 32% year-over-year growth, easily beating consensus estimates. It proves that Microsoft's massive CapEx gamble is paying off because enterprise clients are absolutely willing to pay a premium for that infrastructure.
It's a closed loop of enterprise spending. But then we look at Apple. They posted their strongest June quarter results ever. $109.4 billion in revenue, which is 16% year-over-year growth, a 29% jump in earnings per share.
Huge numbers.
And it was broad, too. Double-digit revenue increases across the iPhone, Mac, and services. Every geographic region grew. And crucially, their installed base, the total number of active Apple devices in the world, hit an all-time high.
And that installed base metric is the ultimate moat. It means the ecosystem is expanding. But the divergence here is what's truly fascinating.
What do you mean?
Well, Microsoft, NVIDIA, and Salesforce are proving that business-to-business enterprise spending is firing on all cylinders. But Apple's numbers prove that the global consumer is still incredibly resilient. Despite all the inflation fears over the last year, consumers are still upgrading to premium hardware and paying for recurring services.
Right.
It cements the broad-based strength of this entire Magnificent Seven cycle.
Let's pull back from the mega caps for a minute, because this AI supercycle is causing some massive ripples through the semiconductor supply chain. And we also have some fascinating movement in the traditional economy. Let's start outside of tech. Gap jumped 12% today after appointing a new CEO for Old Navy to try to revive the brand.
It's a great reminder that while AI is driving the broader indices, traditional retail is still a pure execution game. Old Navy has struggled with comparable sales, and the market is instantly rewarding the prospect of better management.
Contrast that with Qualcomm, which is drawing a lot of attention today in the tech space. They're currently trading at a 15.3x forward earnings multiple. Now, for anyone unfamiliar, a forward earnings multiple is just the stock price divided by the company's expected earnings per share over the next year.
Right.
In the tech sector, 15.3x is considered incredibly cheap. But Qualcomm is in a really complex position.
Right.
They're a leader in AI for mobile devices, but they are losing Apple as a customer, and memory costs are rising.
Qualcomm is trapped in a brutal tug-of-war right now. The bull case is Edge AI. Right now, most AI processing happens in a massive cloud data center.
Yeah.
But the future is processing AI directly on your smartphone, the edge of the network. Qualcomm's chips are essential for that.
But the bear case is the Apple divorce.
Yes. Qualcomm currently supplies the baseband chip for the iPhone. That's the critical cellular modem that allows the phone to actually connect to a 5G network. Apple has been working for years to build their own baseband chip in-house.
Oh, right.
When they finally succeed, Qualcomm is going to lose a multi-billion-dollar revenue stream.
So if I'm looking at Qualcomm trading at a seemingly cheap 15.3x multiple, is that a deep value play for someone who believes in the future of mobile AI? Or is it a value trap because that Apple revenue hole is just too big to fill?
It's the classic semiconductor transition risk. The market is pricing in the loss of Apple. I wouldn't definitively call it a trap, but it requires serious patience. Qualcomm has to prove to Wall Street that the new revenue from mobile AI processors can outpace the eventual loss of the baseband modem business. It's a highly uncertain transition.
Rounding out the supply chain, we got news from SK Hynix. Their CEO confirmed they're breaking ground on their first U.S. facility in Indiana, expecting it to be a key memory production base by 2030.
This touches on two massive themes: AI infrastructure and geopolitical diversification. You cannot run an NVIDIA GPU without something called high bandwidth memory, or HBM. Think of an AI processor like a massive engine. It needs data fed to it constantly. Standard memory is like a garden hose. It's too slow, and the engine starves. HBM is like a multi-lane superhighway that feeds data to the GPU at lightning speed. SK Hynix is a global leader in HBM.
And building it in Indiana by 2030, that's entirely about securing the supply chain against tensions in Asia, right?
Precisely. It's a slow-moving, incredibly expensive shift to onshore critical semiconductor manufacturing to the U.S.
So we've covered a massive amount of ground today. Let's synthesize this.
Right?
We need to zoom out and tie these micro-tech movements into the macroeconomic picture. Looking at today, it feels like we have two crystal-clear tech themes.
Right.
Theme 1, NVIDIA's fundamental numbers entirely validate the massive AI infrastructure investment cycle. Theme 2, the Magnificent Seven earnings conclude on a high note, proving that both enterprise software spending and consumer hardware spending are incredibly resilient.
Which brings us to the third theme, and arguably the most important one for the broader economy, Jackson Hole tomorrow. Federal Reserve Chairman Kevin Warsh is set to deliver his keynote address. This is the stage where the Fed traditionally outlines its policy framework for the coming year.
Given this massive tech euphoria we just spent the last 10 minutes dissecting, what is the market actually expecting Chairman Warsh to say?
Well, if you look at prediction markets, specifically Kelshi, traders are pricing in a very low probability that Warsh will signal any upcoming rate cuts or even explicitly reference easing the bond markets.
Oh, really?
Yeah, the expectation is a highly measured, cautious policy stance. He has to look at the explosive corporate growth and profitability we just discussed and balance it against inflation.
And he has extremely good reason to be cautious, because we got some surprising domestic data today that complicates the inflation narrative significantly. August apartment rents turned positive for the first time in 4 years. Rents are actually going up again.
That is a vital and honestly troubling data point for the Fed. Housing costs are the stickiest component of inflation. For the last 4 years, rents were cooling because of a massive boom in apartment construction.
Right.
But high interest rates made borrowing too expensive for developers, so new construction crashed. Now the supply of new apartments has dried up, vacancies are declining, and landlords are raising rents again.
And on top of housing, we got estimates today that the 2027 Social Security Cost of Living Adjustment, the COLA, could reach up to 3.6%. That is a significant bump that injects more cash into the consumer economy.
It is. When you have rents reaccelerating and entitlement payouts adjusting upwards by 3.6%, the Fed's hands are effectively tied. They cannot aggressively cut rates in that environment.
Which brings me to the final thought I want to leave everyone with today. We've spent this entire deep dive unpacking an unstoppable, self-sustaining corporate spending cycle driven by AI. We're watching hundreds of billions of dollars flow into hardware, data centers, software ecosystems, and cybersecurity.
Yeah.
It is a historic wealth creation event. But at the exact same time, the fundamental costs of living, like housing, are quietly ticking back up because of supply shortages.
Right.
Could the Fed's expected measured stance tomorrow actually be too passive? Is it entirely possible that this massive, multi-trillion-dollar AI growth cycle is going to inadvertently reignite inflation right when the Fed thought they had it contained? Because if corporate America is spending with this kind of velocity, it eventually bleeds into the broader economy.
Absolutely.
It's something to seriously mull over as we wait for Chairman Warsh to take the stage tomorrow morning. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.